Hi, this is Dee with Brown Girls Invest 2. I am at the end of the month and I'm going to cover my July dividends. I'm going to answer two questions and try and get this done kind of quickly. I hope I can. Um, I'm trying to get this done because in the next 10 days, I'll be preparing for the Redefining Life Abroad Summit that I will be participating in. I hope you guys will attend. I hope you have your tickets. I will leave the link in the description of this video. So let me get to these dividends and then I'll answer a few questions in just a second. 1 minute. Okay, so for the month of July, today is the last day. I received $998.65. I was paid from a total of 11 companies. Those 11 companies or index funds. So for the first week of July, January 1st through the 7th, I received $177.67 from Schwab US Dividend Equity ETF, ticker symbol SCHD. On the 2nd, I received $43.72 from Vanguard Total Stock Market Index. That's ticker symbol VTI. On the 3rd, I received from the ProShares Ultra Pro QQQ fund, the ticker symbols TQQQ. I received $14.58. In the second week of July, from Fidelity 500 Index Fund, FXAIX is the ticker symbol. I received $35.45. Then on the 10th, I skipped a date. I'm sorry, no, I was also paid from Merck on the same day. Merck is ticker symbol MRK. I received $381.40. And then on the 10th, Lam Research paid me $20.12, ticker symbol LRCX. On the 11th, from Taiwan Semiconductor, I received $45.16. And then, excuse me, on the 15th, Stag Industrial sent me $40.94. I didn't receive anything in the fourth week, but in this final week of the month, Wisdom Tree U.S. Quality Dividend Growth Fund, ticker symbol DGRW. I always mess that up. I received $9. And then today, I was paid by JP Morgan Chase, ticker symbol JPM, $222.97. And finally, I also received from the Invesco QQQ Trust Fund $7.65. All of those payments total $998.65. It looks like August. It looks like I'm going to have a little more of a haul in August. But again, I'll cover that at that time. Now I want to move on to the questions that I received. Let me stop sharing. Give me 1 second. As I mentioned earlier, I've been a little tied up getting prepared for some events that I have coming up. And so I received these questions. There are two of them that I'm going to cover. Sorry it took me so long, but I'm getting to it just like I promised I would. The first one comes from Dex C8215. She says, "Hi Dee, congrats on this channel. We can see how over time, 35 years, how those reinvested dividends add up to produce the amounts you shared with us. You also said here in one of your replies that, quote, that I started with small amounts of money, like $50 every 2 weeks or something like that. Was your strategy to invest 50 every 2 weeks per stock that you had in your portfolio at the time? And since you've amassed these amounts, do you still allocate money each week or month to your portfolio, or do you now just let the reinvested dividends work for you? Thanks." All right, so that question was from my last dividend video in June. And here's my answer to you. So let me just get this off 1 second. All right, what you can do, what happens when I'm saying at that time, put in $50 every 2 weeks and you just needed small amounts of money. I'm really talking to people that are just starting to invest or people that don't have a lot of money to invest, right? So this is a way for you to dollar cost average into building a position in a stock or in an index that you want to own. Now, what building a position can mean is that you're building a share size position or you're building a dollar amount position. Okay, so when I say build a share size, say you want to own 100 shares of this company, 1,000 shares of this company, or 20 shares of this company, whatever the case. If you're putting in $50 every 2 weeks or whenever you're able every month, that $50 may not buy a full share of whatever you're trying to buy, but it will buy a fractional share. And over time, you're going to be able to build up to the share amount, that the share count that you want to own of that particular stock. Now, if you are putting those same small amounts in and you're trying to get to a $5,000 capital position in that company or in that index fund, it is the same thing, right? What I don't want to see people doing is buying one share of this company and one share of that one and two of that one. I don't want you doing onesie twosie. You need to, your money needs to be focused into any particular thing to grow, right? So I'm not saying that you can't buy, some of this company and some of this company, right? But I don't want you spreading your money so thin that it's not gonna, you're not gonna see a whole lot of growth with it, right? So you want to build a position size or a capital dollar size in any position that you own. Now, the next part of this is, do I still do that? No, I do not. I do not. I do not put in regular amounts into any stock. What I may do is I may have a chunk of money where I say I want to own a particular stock or I want to buy more of what I already have, and so I may dump maybe $2,000, $5,000, $10,000 into any particular thing, or if I see an opportunity or a company or an industry, right? That I am not in, that I want to start building a position. So I may be, for example, starting to build a position in AI focused companies or ETFs or index funds, right? Yes, what I do now is, for the most part, I allow my dividends to continue to purchase shares from me. So remember, those $50 that you're putting in ever so often, you may not be buying a full share, but the dividends that they are paying you every month or every quarter are helping to buy more shares of that company and build your position in that stock or that index fund or ETF. Okay, I hope that answers your question. I'm going to pause here because I got one more question and hopefully I can wrap that one up pretty soon. Okay, so the next question, it was asked from this same video. It was asked by Yvette Boone, who has a YouTube channel, Yvette Boone Creates. She is a plant mama and a creative hobbyist. Take a look at her channel. She's got really great content. I think you'll get a lot out of it. And she actually gives some life lessons with the growth of her plants and just nurturing her plant life, okay? All right, so Yvette says, great video, D. I may be in the minority here, but I would like to see what a dip/healthy pullback looks like in a portfolio. Maybe a simulated portfolio from the past, 2020 being an example, of course, but show what the not great part looks like so we can see that it's not so bad. I guess I'm in the mindset, if we can see the worst case scenario, then maybe we can reduce the fear or completely scare us away from the market altogether. Don't ever be scared away from the market altogether. Just a thought, if you ever decide to indulge us, I take a front seat. By the way, thanks for sharing a peek into your portfolio here. So Yvette, sorry it took so long, but I did get around to doing what I said I was going to do. All right, so now, to do this, I need to switch gears again, so give me 1 minute. Okay, so before we go into the chart that I'm going to show, we need some terminology, okay? So the first term, Yvette mentioned a pullback. She said a healthy pullback. A pullback is generally a 5 to 10% pullback, okay? And that can happen in a few hours or over a course of days. That is what a pullback is, 5 to 10% drop. Okay. Now, next is a correction. A correction is generally going to be a 10% correction going down. A correction can happen over a course of hours and over a course of days. All right. Now, the next term, you'll hear people say this a lot, but they're not correct when they're saying it. They'll say the market is crashing. Now, a crash does not actually have a percentage amount. What it generally means is that there is a double-digit drop. And a crash can happen. It could be a flash crash, which can happen in hours, minutes. It could be over a course of days. No, that's not right. Can't be days. It could be like in the same day. Or you can have a full out crash, right? Where that can happen over a course of days, over a course of weeks, months, and even years. So an example of a crash was back in 19, it actually started in 1928. Started in 1928. In 1929, the market dropped. If I remember, not remember, if I check my notes, yeah, the market went down 21%. And that wasn't the full on of it. Unfortunately, the market went down from 1929 to 1932. That was the Great Depression. All right. In that time, stocks unfortunately lost 90% of their value. That has not happened in, oh, well, I guess we're coming up on 95 years here, right? So that is not something that is common. It has not happened often. Don't let that frighten you. I will show you what has happened over the years past. I'm not going to cover everything. I'll cover some of the major ones. Now, I'm going to switch over to a chart to give you a better example of what I'm talking about. Okay, as I said, maybe I didn't say. I normally use Thinkorswim for my chart as my charting tool, but a lot of people may not have access to that. But what you do have access to is Yahoo Finance. So I pulled up a chart in Yahoo Finance, and I think I used the time frame of 19. Apparently, I used 1970 or somewhere like that until present. Right. I have this on a monthly. Yes, I have this on a monthly chart over that time frame. So the first thing I want to bring your attention to is this area right here. This is 1987. 1987. I'm gonna be checking my notes. I don't want to quote the wrong thing. So in October of 1987, Black Monday happened. That is when we had the largest single day drop in the market. That was a 22% drop in the market, and people were happy. Okay. But again, what I also want to tell you again, stair step manner. Remember, the market moves, it doesn't move in a straight line, it goes up, pulls back, moves up, pulls back, goes up, pulls back. Okay. And so I am showing you this so that you know the time frame that we're in right now. Even though you may see a bit of a pullback, you are not really seeing the worst it can be, right? And so one other thing you should know is you don't make your money in an up market. You make your money in a down market, and I'll show you how in just a second. So I'm going to zoom in just a bit. If I can go in a little bit, not too much. There. All right. So this is, I told you October, right? Right now I'm sitting on September, and this line here, that red line, that's October 1987. That's the 22% drop. After it dropped, it started to recover. Now it did take, I'm going to go about here. What I'm doing is lining up this area where the market was when it made its fall to this area. And so that is the following year in June. That's not the following year. That's 2 years. It took 2 years to recover from that drop. So I actually made a mistake, and I'll explain that mistake to you a little later on. But again, so here's the market. It pulls back, moves up, does a little consolidation. There was a pullback, it moves up, a little bit of a pullback. So I'm not going to cover all of the times it pulled back. I'm covering the major ones. All right. So now I'm going to go all the way to this area, 1990. 1998, and then into 1999. I'm going to make it a little bigger so we can see this better. One more. Yeah. All right. So this is 1998. I'm sorry. This is August of 1998. The market dropped. In 1998, we were building up to, um, do you remember the dot-com bubble? Dot-com went dot-bomb and tanked, right? This was the time frame that we had where we needed to recover from that, and it took us. Am I on a monthly? Yeah, I'm on a monthly. To recover from where we were, it took about this is yeah, it took like 3 months to recover from that drop, right? And then from there, it pulled up, went up again, right? Um, I don't like this chart. I want to drag it. Can I drag it this way? No, you cannot. Oh, no, I didn't want to do that. 1 second. Okay, so here's another significant time that I was actually affected by, and it took me a little bit to recover, but I did recover. And by the way, when I say that, it was recovery in the housing market. So in 2008, we had the housing bubble, right? There we had all of these subprime mortgages, and the banks wouldn't be bailed out, so we tanked. And in doing that, from the height at that time, in that 2007 height, it took about, so 2007, I'm going to say about 2013, 2014 to start to recover from that pullback. At that time, actually, I don't have the amount that it fell, the percentage that it fell, but you see what it looks like on the chart. Um, and I'll give you an example of how you make your money in down markets. If you're buying here, if you buy in when it's low versus if you had bought here and it tanks after that, so you've lost value. When you buy in when it's low, if you can. But if you're consistently investing, it doesn't matter your dollar cost averaging in, you're going to end up leveling off how much you pay for any share. So I am not saying to stop investing as it gets to a height. You'll just end up buying less shares at the high and more shares when it's low. That's all. All right. So now, again, so after the housing recession, that recessionary period, we start to pull up. There's a little consolidation. We do a little more pull up. All of this. So again, I'm going to the very significant portions in time, and so I'm going to make this a little bigger because I need to be a little more this way. Yeah. I think one of them, here's the most significant. This was actually pretty recent for us. Now, I retired in January of 2019, and I know better, but I made a mistake at this time. So because I retired in January 2019, a full year went around, and in December of that year, we started to see cases of an illness that no one knew what was going on, and people started, anyway, we started to see an illness. And then fast forward to February of 2020. In February, I think it was February 17th, boom, the market started to tank. And what happened at that time is companies started to shut down. So from February to like toward the end of March, companies were shutting down, countries were shutting down, and some companies started to either reduce their dividend payments, they cut them all together, or they paused them for a minute. Now, I was not using my dividends to live off of at that time, but when I started to see the market tank like that, do I have the percentage? Yep. The market lost 12% in one day. That was quite a lot. And so, again, a crash is anything that is a double-digit drop. That was a crash. So I sold off some of the companies to preserve money, or at least that's what I thought I was doing. Unfortunately, what I did is I locked in a loss. You should never do that, and I'll show you an example later on. I have recovered all of that and then some, so I'm fine. And don't you ever think that you need to pull out when the market tanks like that. Hang in there. As long as the companies are good companies, they're going to recover. All right. So now let me see if I can just pinch this, and I cannot. Anyway, so this shows where we were in, this is like March of 2020. No, this was going to be March of 2020 right here. Now, I told you I sold off some of my shares and I locked in a loss. Had I been patient and waited till August, that's all it took for it to recover. The market recovered August and September. The market recovered. And from then on, it was on to the races. Let's see if I can do this. There we go. Bring it down a little more. There we go. Okay. So here's that drop, right? And then let me make sure that's it. Yeah, that's the drop. Here's that drop. And then from there, it just pulled up, went back, and here we are at this point right now. Again, if I had bought in right here or just hung in another 4 months, I would have recovered my money. But if I was just putting money into the market, I would have made a killing. So I told you earlier in one of my responses that sometimes I'll have a pot of money. And by the way, if you have money sitting to the side, that is called having dry powder. Okay. So if you've got dry powder, if I bought in at that point, boom, you're making money from then on. So any little pullbacks you're seeing right now, don't worry about it. You're fine. We are not in a we're not in a correction zone. We're not in a crash zone, and the market always recovers. All right. So I want to show one other example, and then I'm going to cut it off because I think I'm running long now. Hang on. Okay, that what we are seeing here is a actual account with the real loss that I incurred in. Well, it's probably, yeah, that was year to date. So what you're looking at is the December 1st through December 31st statement of one of my Fidelity accounts, and even though it says it's only for that month, what I'm showing you is there's a year-to-date loss. I took 140. I didn't take it actually. I lost $143,000, $143,000 value loss. Value. I said value because you don't lose anything. You don't make money unless you sell. You don't lose money unless you sell. Okay. In this case, I sold. Okay, so what you're looking at is the actual loss that I locked in. I locked in $143,043.49 loss for the year. Because I made the mistake of selling in a down market, and I shouldn't have done that. I knew better at the time, but I had experienced things like that before, but what I had not experienced was a pandemic and countries and companies shutting down completely. So I got panicked. I'm gonna be honest, and unfortunately, I lost $143,000 that year. But what I want to also show you. I'm not going to show you. I'm going to tell you. I made that money back and then some. I showed you on that chart where it pulled back. It only lasted until August or September. That market came back, and it's even gone further since there. So all of that money has been made back. You also see a subtraction here of about $64,000, and because that's I think this was the year that I purchased a car, as well as sometimes I will take out lump sums of money and put it in. I'll take a hit for one time because I'm younger. I get a penalty for taking money out of retirement accounts. Anyway, I was purchasing a car and also putting money to the side to be in an account for me to pull off of and live for the following year. So that's your example. I hope that all of this has been clear and that you got a good understanding and an answer to your question, or at least being able to see what a pullback is, 5 to 10% drop. what a correction is, a 10% drop, and then what a crash is, a he is drinking that water. um, it is a double-digit drop in the market, in a stock, or in an industry. Okay, I hope you got what you needed. Thank you guys so much for watching. If you enjoyed this, go ahead, hit that like button, subscribe to my channel, share it with your friends and family, and I'll see you in the next video. Have a great one. Bye.